Hey everybody, it's John King. It is Friday, the 29th of July. I am actually on vacation right now, but such big news that's going on this week that I want to make sure to catch you up. I'm taking a few days off before my kids start school in a week and a half, but wanted to really keep you informed because there's a couple of really big news pieces that came out this week, and I want to cover those in detail. So first and foremost, on Wednesday, the Federal Reserve raised interest rates again. They raised them by 0.75%. That's the second time this year they've raised rates by 0.75%, and the fourth time that they've raised interest rates. So in March, they raised rates by 0.25%. In, I believe it was May, they raised them by 0.5%. June, they raised them by 0.75%. And then here we are in July, and they've raised them by another 0.75%. And they're not done. So we're going to see interest rates continuing to go up. But I need to remind you, that is not mortgage rates. The Federal Reserve does not control mortgage rates. What they control is rates that banks charge each other overnight to borrow money. They control interest rates on your home equity lines of credit and your credit cards, but they do not control mortgage rates. The reason the Fed is raising interest rates is to stop inflation. They're trying to slow down the economy, to slow down inflation. So I want you to think about these rate hikes as medicine. And that medicine is working. The increases in the Fed rate hikes, in the Fed rate, is starting to slow inflation. It just doesn't show it yet. The numbers are actually worse now, but the difference is we're not seeing the mortgage rates spiking, even though this month we saw the biggest increase in inflation that we've seen all year. So why is it that we're going to have the biggest increase in inflation that we've seen so far, and yet mortgage rates don't jump? The reason why is because the medicine the Fed is providing is working, and that is meaning that we are going to see inflation start to subside. We're just a few months away from making that happen. So what does this mean to you? What it means to you is a couple of things. It means mortgage rates are actually responding well, and they actually came down on Wednesday, Thursday, and today, Friday. We've seen a little bit of a decrease every single day in mortgage rates. That isn't the case of what we've been seeing all year long. So that again tells me the medicine is working. But here's the reality. That medicine is going to create a new disease that I've been telling you about, and that new disease is going to be recession. You've probably heard in the last 24 hours some pretty big news about we might be in a recession already. Well, that depends on the definition of a recession. There's the loosely held definition of a recession, which is 2 consecutive quarters of a decrease in gross domestic product. Now, what does that really mean? It means that gross domestic product is the amount of goods and services that are created or sold in the United States. And if we decrease that 2 quarters in a row, that's the general definition of a recession. But there's more to it. The federal government has a body that oversees it, and they basically say, look, that's kind of the telltale signs of a recession, but it really has to do with employment and unemployment rates and a lot of other things that are happening within the economy, and we're not seeing those other indicators yet. So there's going to be some talk of, hey, we're in a recession or not, but that's just more a statistic or a talking point or a headline. The fact of the matter is, the economy is going to get worse, in my opinion. That's actually going to lead to better mortgage rates. I think that we're right on track with what I've been saying, which is in the next 12 to 24 months, we're going to see lower mortgage rates than what we have today. And last week I made an argument that I think we might actually have we've already seen the peak of mortgage rates. Now, I'm not sure if that's the case or not, but if you didn't see my video last week, go onto my YouTube channel. You can check out the video, and I talk about a lot of things over the last few weeks, but last week I talked about why I think we might have already seen the peak of interest rates for mortgages. The fact of the matter is, whether we're in a recession or not, whether they call it a recession now or they wait a few months or 6 months or a year, the fact is we are still going to see the Fed raising short-term interest rates. So if you've got a home equity line of credit, if you've got a lot of credit card debt, those rates are going to continue going up and up and up. Now, at some point, they're going to turn around and start going down because we'll be in a recession. But until we're deep in that recession, the Fed's not going to start lowering that rate. So you've got to think about, should you take advantage of consolidating that debt right now or not? I think it's a great time to look at debt consolidation if you've got a lot of other debt that's being increased in interest rate because of what the Fed is doing. The other thing I'll tell you is I continue to believe it's a great time to buy if you are a first-time home buyer or even a repeat buyer who has a small amount of money for a down payment, or if you're a move up or move down buyer, meaning you own your current home and you're trying to buy something bigger or smaller. Because I think that demand is low simply because rates are high. And as soon as rates come back down, demand is going to skyrocket and supply is super low. Now you're going to say, John, what do you mean supply is low? We see inventory of existing homes for sale increasing significantly, so supply is going up. That's not supply. Supply is the number of homes that are literally out there available to be occupied. And the fact of the matter is, there are too few homes compared to the, and I'm not even talking about purchasing, I'm talking about renting or owning. There are too few homes out there to be lived in compared to the number of people that need to live in those homes. So we have a supply issue. And the only thing that's going to help that is building more homes, and builders have slowed down their building. So we've got a situation where if you're looking to buy a home and you're struggling with down payment money, you might need seller credits, or you have to sell your home and be contingent on the sale of your home. I think the next 6 to 12 months is the best time for you to buy, because beyond that, we're going to be in another market like we were in 2020 and 2021, where you're going to be in a highly competitive market and you're going to have a really hard time getting your offer accepted. So what's the last 5.5 minutes been about? Simply this. The Fed raised interest rates again, but it did not increase mortgage rates, and I really don't think we're going to see mortgage rates significantly higher. I think we'll see them continue to bounce up and down, but I think what we've seen in the last month might be the peak of what we're going to see in this cycle. And the second thing is, a recession is a statistical thing. What you need to think about is, how does it impact your family? What are you looking at to make sure that you've got good reserves in your household, that you're saving some money, putting it aside for a rainy day, maybe minimizing your amount of debt, or like I said, consolidating your debt to make sure that you're prepared. Let me know if you have any questions about anything. Hope you all have a great weekend, and we'll talk to you soon. Bye-bye.